In this video, we're going to cover preferred shares, non-cumulative and non-participating. So we've got this question here. ABC Inc. has the following. Preferred shares 10%, meaning that the preferred shares get 10% dividend based on the carrying value of the shares, the original selling price. The number of shares is 2,000 and the total carrying value of the preferred shares is $200,000. Then we have the common shares. There is 16,000 common shares outstanding, and they are valued at $800,000, which is, of course, the carrying value on the equity section of the statement of financial position. The company is paying a $140,000 cash dividend in the current fiscal year, required. Assume the preferred shares are non-cumulative and non-participating. How would the cash dividend be distributed between the preferred shareholders and the common shareholders? So first, let's describe non-cumulative. This means that if dividends were missed being paid in a prior year, they are lost forever. If the company does not pay dividends in any given year, the preferred shareholders have no rights to the unpaid dividend. It means there are no dividends in arrears. They are never going to be paid. So what is non-participating? It means that these preferred shareholders will receive 10% only and nothing else. The preferred shareholders have limited dividends. They'll never receive more than the dividend percentage or dividend dollar amount that is on the face of their share certificate. All right. Given that the preferred shares are non-cumulative and non-participating, how will the dividends be distributed in the current year? Let's do a quick chart. We've got the preferred shares, common shares, and a total. The preferred shares are going to have a dividend equal to 10% of their carrying value. So we're going to take the 10%, we're going to multiply it by the $200,000 of carrying value is equal to $20,000. And so we can add $20,000 to the total column also. Now what about the common shares? They're going to receive the remainder of the cash dividend. So if I take the full cash dividend of $140,000 and I subtract the $20,000 that we are paying to the preferred shareholders, the common shareholders are going to receive a full $120,000. And I can add the $120,000 to the total column. And so the total amount distributed is the $140,000. $20,000 going to the preferred and $120,000 going to the common shareholders. It's a fairly straightforward calculation when shares are non-cumulative and non-participating. Let's extend our learning. What would be the entry on the date of declaration? We would have to recognize a liability immediately as soon as the board of directors declares the dividend. And that would be a debit to cash dividends for the preferred, $20,000, a debit to cash dividends, common, of $120,000, and a credit to dividends payable of $140,000. What would be the entry on the date of record? This is the date when the company notes down the owners of all the shares for both preferred and common. In this case and every case, there's no entry. What would be the entry on the date of payment? In this case, we're going to recognize that the liability is now settled through an outflow of resources and cash has reduced. That would be a debit to dividends payable of $140,000 and a credit to cash of $140,000. Thanks for watching.